We have one final panel remaining and then some last words from one of the founders. And again, at Optio and Entice Happy Hour, which is right down there, that goes until 6:30 or so. We do have food and drinks for you, so make sure you take advantage of that, as well as a lovely rooftop with some great people as well. And then obviously you have the whole casino to your disposal, whether you want to watch people make or lose money, or you want to stay completely away and probably protect yourselves. But anyways, for our next panel, we have TradFi to DeFi. And we're bringing two worlds together, TradFi, traditional finance, and DeFi, decentralized finance, building bridges in blockchain, which explores how traditional finance and decentralized systems are converging to shape the future of money. So, please, without further ado, let's invite our moderator, Ashton Addison, to the stage to lead this discussion, and the rest of our speakers. If you can, give one more round of applause. I have now.
All right, thank you guys so much. Thank you for sticking around. We are here to deliver some alpha for those that stuck through it, and hopefully you guys had a great day one. We have some heavy hitters on the stage. It's an honor to be with you guys. We got some crypto exchanges, public companies, institutional DeFi with billions under management. I'm Ashton Addison, CEO of the Crypto Coin Show. I've been running a YouTube podcast interview since 2014. I've had thousands of projects on the show. We had Sidney from Maple back when he just started about 5 years ago, and now they're just reaching 5 billion assets under management. And we got, well, I'll let you guys introduce yourselves. Maybe you just do like a quick on yourself and what you guys are working on, and then we'll just dive into the topics.
I'm Sid Powell. I'm the CEO and co-founder of Maple Finance. For those who don't know us, we are an on-chain asset manager, but really we focus on institutional lending. So we do loans anywhere from 10 mil up to 200 mil, usually against Bitcoin, ETH, Solana, XRP. So, you know, think large cap collateral. We run around 5 billion AUM, and we've been doing this for about 5 years now. So very happy to be here and talk about institutional DeFi.
I'm Charles Allen. I'm the CEO of BTCS. We're a NASDAQ listed public company focused on Ethereum infrastructure. We also hold you know, a nice, healthy pile of Ethereum as well.
Hi, I'm Roshan Robert. I head up OKX in the US. OKX is probably one of the oldest infrastructure firms in public blockchains. And we are the second largest exchange by volume globally. We've recently launched here in the US in April, and we continue to scale.
Very exciting. And I want to start out with just like a quick icebreaker. And, you know, in the last 2 years, we've had a lot of institutional capital come into the industry, which has been great. And there's still so much more capital to come, which is even more exciting. And I think there's a lot of innovative companies that have been doing this for a long time, like BTCS, but there's some that are on the fence, and maybe there's a misunderstanding in the technology, or they just see the volatility and other things. To open it up, what do you think is like one of the main reasons that sort of TradFi is misunderstanding DeFi, or they haven't gotten involved yet in it? Sid, you want to start?
Yeah, I can kick that off. So I think, just looking back 12 months ago, a huge reason for institutions and traditional finance to kind of take a pass on DeFi, I think, was regulatory concern. We've seen that do a total 180 this year. We've seen the Genius Act get passed, which, for those who haven't been following, creates a framework for stablecoins. So now institutions are no longer worried that the stablecoin could depeg and they could lose money that way. And then we've also seen the SEC take a much friendlier and supportive attitude to the innovation from the space. They're discussing tokenization, the benefits that brings to consumers, and then I think as well this year you've seen more Web 2 companies start to participate. So we saw Stripe do a huge acquisition of Bridge, so they could provide stablecoin services, and I think that's only going to continue. And one of the other driving factors that's pushing us forward, I think, is folks in the traditional finance sector are looking at how profitable companies like Tether have been from crypto-first business models. So I think that's all sort of combining to help things.
Yeah, I mean, if I would add on that, I think you're spot on in terms of the regulatory clarity. So there's a lot of outside capital or institutional capital can now flow into, into the crypto rails. But for a lot of institutions, they've been, because they're on the sidelines, they have to come up the learning curve. So there's a lot that are already educated, but there's still a huge swath of institutional investors that don't really understand it yet because they haven't taken the time to learn it, because for the better part of the last decade, it was kind of off limits to them. So I think, now that they can come in, we should see a lot more institutional capital get educated and see those flows come in.
Well, Charles, as a public company, and you guys have been deep in crypto and digital assets since like 2014, you've probably seen, the regulatory hurdles up and down. How is that, being a company that was like, we're all in, like from the beginning, way back, before all these risk-averse companies are even thinking about this? How did that work, like sort of back in the day compared to now, and like making it easy to grow the company?
It's night and day. I'd say the last, we've been public 11 years. The first, 10 years, basically a decade, the SEC was trying to put us out of business. So we've, as a public company, I think filed more registration statements than any other public company, probably 40 or so. We've answered more questions. They've investigated us. They've suggested we're a investment company, a registered investment advisor, a broker-dealer. They've wanted us to explain why Ethereum isn't a security, despite, Jay Clayton, the former SEC chairman, basically stating it wasn't. And so fast forward to this year with the new administration, it's night and day, right? They dropped their investigation against us, as well as probably every other crypto company that they were, frankly, illegally investigating, and have allowed us to access capital. They're not holding us up on registration statements, and so it's been nice to be able to focus on actually growing a business instead of wasting time crafting letters and working with lawyers to address SEC comments and worrying about every single word you write in a press release, because the biggest viewer of our website was the SEC. We were literally watching them watch us. We hired engaged a service to do that, and it's pretty scary when you literally are engaging a firm to watch the SEC watch you, and you're playing this cat and mouse. So I'm excited 10 years later to not have them on my back.
It's crazy the flaming hoops you've been jumping through. And Roshan, OKX being a majorly successful crypto exchange internationally, then jumping into OKX US, now with the green light from the administration in the last 12 months, how's that been for you, sort of not having to go through 10 years of hurdles, jumping in? How is the administration and the regulation and making sure that you guys are sort of competing with the best of the best American exchanges?
Yeah, great question. I think, what we've done is we started this journey in the US. So I joined OKX in the summer of 2024, right? That was before the new administration. So we always had the intent to sort of really enter the US market, and enter the US market with the right kind of with the right kind of infrastructure, with the right kind of governance, with the right kind of frameworks that will allow us to expand across the multiple opportunity sets, right? So we've, like I said, we are probably one of the oldest infrastructure firms in the world in the space of public blockchain finance, so to say. We are largely an engineering shop with over 2,500 engineers and product people around the world who support the infrastructure. And what we've done over the last many years is to build the right kind of technology that helps to harness over 130, 140 blockchains and allow people to transact on it in a proper fashion, right? So build all of the services and the front ends and the back end architecture that is needed for people to be able to transact seamlessly on this. Over the last couple of years, when in entering regulated markets, what we've done is we've taken this infrastructure and we've placed it on what I would call as the 5 pillars of finance, right? So we've built a proper compliance framework. We've got nearly 500 people manning all of the different compliance functions around the world. We've got a very robust risk management program. Our risk management function is now nearly 100 people around the world who look at all applicable risks of the ecosystem. Cybersecurity. So you know, like I said, we are an engineering shop, and this is public blockchain finance is all about moving money on the internet, right? And you know, part of the reason why a lot of firms, traditional firms, struggle is because you know the risks are unknown, or they don't really understand the risks of this. So we built out a real solid cyber framework, and then of course client money controls, you know, sales practices, and the governance around all of these areas are robust and performed in a disciplined manner. I think that is an important foundational step to building in the US, and that's what we've done before we launched.
That's incredible. And with the bridging of TradFi into DeFi, is there a hybrid approach of like centralized DeFi, CeDeFi they call it, or DeFi products? And is that an interest of institutions and what you're seeing in the market right now?
Great question. So I think over the next few years, the boundary lines between you know CeFi and DeFi and TradFi is all going to sort of really tumble down, right? Like you know those boundaries are going to sort of really disappear, and what's going to sort of really matter is there's going to be more and more products that get distributed on public blockchain. There's going to be more adoption of the public blockchain infrastructure, and at that point, what is primarily important is while you want to keep bad actors from entering that space, both regulators as well as innovators like all of us and all of you in the audience who are innovating in the space, there is a responsibility to bring in more innovation, and there is also the responsibility to bring in financial inclusion, right? And financial inclusion means that all of us would need to start thinking about ways in which you can make these products that are available on DeFi visible to the larger population, to the larger retail and institutional folks who want to get into the space. So yes, that's a long-winded way of saying yes. We definitely want to look into this space.
I can add some thoughts to that. So. We ourselves have tried to adopt a kind of hybrid CeFi or centralized and decentralized approach to our products. So our core product is we do generally pretty large loans, so 10 million and up to institutional borrowers. But what we've done is we do the hybrid is that we will lend them stablecoins through a smart contract. So it's very DeFi first. We source all of the capital that we lend them through DeFi, ostensibly. So we have products that are available in partnership with Aave and Pendle and some of these other large protocols. However, what we offer them is more tailored to institutional borrowers in that they can plug in their preferred institutional custodian to hold their Bitcoin instead of putting it in a smart contract, because a lot of these institutions are averse to smart contract risk for various compliance, legal, and technical reasons. And so we've given them this hybrid where the loan is on chain, it looks very DeFi, but the collateral and how the collateral is managed is very CeFi, and it's buttoned up, and it makes their legal and compliance teams comfortable.
When you're looking at on-chain loans, there's also, as you're saying, it's a hybrid of centralized and decentralized, but as it gets more decentralized, there's also like the credit risk. And that's why if you were totally decentralized, you couldn't just be giving away $10 million loans without having some kind of centralized part there. How does credit risk, and even for retail as well, like if they're looking into DeFi, they want to take a loan, how do you like the way that traditional credit risks and credit ratings worked, how can we apply that in DeFi, especially for financial inclusion in many countries and getting more people the loans that they want?
Yeah, sure. I mean, most of the lending that you see in crypto and in DeFi today is over collateralized, meaning you give me $150 of Bitcoin and I give you a $100 loan. So I'm protecting my downside using the collateral. And then the way that's done in a fully DeFi way is it's all kind of algorithmic. So there's like a set level of collateral that's acceptable for a given loan amount based on the type of collateral. BTC is obviously larger, it's less volatile than something like Solana, for example. Whereas in traditional finance, it's very centered on counterparty risk. So your FICO score, the financials of the company that you're lending to. We haven't seen that make its way as much into crypto because for a long time, audit firms were not willing to audit crypto companies. So it's harder to get a clear view of financials. And then, it was difficult to get access to things like FICO scores to kind of underwrite people at scale. I've seen a few businesses this year start to kind of try and tackle that problem. So I think we'll take steps, or rather we'll make progress towards addressing financial inclusion through on-chain lending and on-chain credit over the next 1 to 2 years. But it's taken time to get there because there have also been false starts. So there have been lending companies that have had defaults or fraud that come through because it is just harder to underwrite somebody in another country and lend to them. And if something goes wrong, it's very hard to get your money back in the legal system of another country. So those are all things that get considered.
Definitely. Well, I feel like the crypto people that, at least the crypto natives, the ones that have been coming to futurists like myself for 7-8 years, I would love to be able to collateralize and then actually use that maybe against a mortgage or against some real world products and have that, at the Chase Bank or not just the innovative lending platform that's we need to make this more standard practice. I think it will be as more institutions accept the fact that people are collateralizing crypto and digital assets in traditional standards. Charles, I want to jump to you because I think the backbone of decentralized finance really is on the Ethereum ecosystem, and I know that BTCS is an Ethereum infrastructure company. You guys are all in on Ethereum, supporting the infrastructure, running nodes, and having a huge treasury of Ethereum of 70,000 plus Ether on the treasury. And most recently, Ethereum's done a really nice return this year, and BTCS paid a dividend, or given the choice, because you weren't going to force it, but paying a dividend to the company, which is more of a centralized thing that's been happening for centuries, in Ether, which is super cool to me. If I was all in investing in an Ethereum infrastructure company, I'd want my dividend paid in Ether. I think that's a world's first. I know you guys have done a lot of world's first stuff. Can you talk about that, which happened in August, and how you think that sort of plays into decentralized finance and using digital assets in a centralized way?
Yeah, and I think to understand why we did that, there's a much bigger story there, right? And if you just look at how the stock market works, it's inherently broken. And what I mean by that is market makers can sell shares that don't actually exist. So it's crazy that that's allowed. It's under market making. If they have a reasonable belief, they'll be able to locate them later. But we've seen companies like GameStop have 140% short interest ratio. And it's wait, you have 140% of your stock total outstanding is sold short. That's impossible. That's got to be fraud. That's like me selling the car title to a car down the street 100 times over, right? You go to jail for that. But it's completely legal in the stock market. And so what we did by allowing for an Ethereum dividend is we incentivized people to move their shares out of their brokerage account and back to the transfer agent. Because at that point, they can't be lent out. So we're basically squeezing the float. And what happened as a result of this is we've dropped the short interest in the stock. It's gone from I think 6 million shares down to under 1 million shares since we did this. And that's a huge win. I mean, obviously we can't control the stock price, but limiting the amount of short sellers and limiting the market maker's ability to kind of play with the stock when you have fundamental investors that want to buy and invest and hold for the long term. And then it's also just cool, right? I mean, if you own an Ethereum company and if you give us your public wallet address, you can actually get some ETH too. So, it's not the first time we did it. We did it in Bitcoin a couple years ago with great results. And so we decided to, we were trading below our net asset value, which is a bit ridiculous. So we rewarded shareholders with a special dividend.
That's very cool. Do you think that seems like a lot of benefits came from that in actually helping the company and getting rid of the fraud and the rehypothecation of like all these stocks that you can just print out of thin air? Do you think other companies will take that step and like follow in the footsteps to pay digital asset dividends?
Yep, so Genius Group, I think they announced a couple weeks ago that they're doing a dividend in Bitcoin with a loyalty payment in the same way we did. So, if you do something and it works, typically others come along and follow.
That's very cool. And what do you think builders in the Ethereum ecosystem, I know you guys are sort of building or helping the infrastructure, what's the number one thing that we need to do right now to, besides like regulation and getting all the parts crossed that you guys have already been through, in terms of the ecosystem, getting more institutions involved into DeFi?
I think we need an on-ramp, right? So all of the institutions have been on the sidelines because they couldn't do anything, but they pretty much have all the customers. So if you're not like a native crypto or a degen that's actually doing stuff on chain, you probably look at like, hey, I had to go get a MetaMask wallet and I'm going to go play with Aave is confusing. So if the larger institutions now have a pathway that is legal to interact with crypto and can start using platforms like Aave on the back end to offer better products and services to their customer base where they don't have to go get the customer, I think that's where you see really big mass adoption of use cases, because the ability for larger firms that are incumbent to their industries to just flip on and start using blockchain technology on, let's say, Ethereum's blockchain is much faster than having to go out and acquire new customers and teach them a new way of doing things.
Definitely. And Roshan, I guess that's where you guys could come in, helping these institutions get onboarded.
Yes, so in a sense, if you look at our global global OKX brand, you'll see that we announced a partnership with Standard Chartered, for example, where we're doing a lot of work with them, that's just the harbinger of more institutions that are lining up to come into this space.
Very cool. And Sid, what do you think in terms of, you guys just hit 5 billion assets under management, which is an amazing, huge, large number, but like the amount of capital in the capital markets that's still yet to come is like unfathomable quadrillions, if you're including derivatives and all the fraud stuff that Charles is talking about that we're just rehypothecating. What do you think about 2025? Now sort of the ETF's been around from the year before, and it's settling in, and it's still the most successful ETF of all time with Bitcoin. Now getting deeper into DeFi. Are you optimistic about 2026 and more capital flowing in?
Yeah, very much so. I think everyone who's looked at the performance of ETFs has mentioned that the rate of growth actually increases over time. So, the Bitcoin ETFs, I think, had a tremendous first year, but that's actually going to get, faster, the rate at which they grow. But I think what's been interesting is this year you've also seen other mechanisms by which capital has come into the crypto ecosystem. Digital asset treasuries, for one. So you're seeing public vehicles be set up, they raise money through shareholders, through convertible bonds, and ultimately that money then gets deployed on-chain to buy assets, or in some instances they're talking about using that in DeFi for earning yield and making their treasury productive. So that's, this suggests to me that you're actually going to see more vehicles, more opportunities for this kind of convergence of traditional money, which is, as you said, Ashton, a much larger pot of capital than what we have on chain at the moment. The opportunity set that we look at is, we at Maple could lend to some of these digital asset treasury companies, whether it's BTCS or others, particularly when they're looking at how do they, when the shares are trading at a discount to NAV, how do they either borrow to repurchase shares or they can borrow to buy more of the asset? But either way, it kind of closes that gap or that mispricing in public markets. And then the other thing that we're seeing more of is we're actually now in conversations with a few banks and asset managers from private credit who are looking at lending, creating large facilities where a player like us can do many loans against Bitcoin or other assets. So they would give us a large line of credit, and then we break it up into smaller loans. But that allows them to kind of enter this space without having to do the legwork of hiring a bunch of people who need to monitor it and manage client communications, because that just takes time. So it allows them to get to market faster. So we're seeing new vehicles for public equity markets, interest from private asset managers, and indeed commercial banks in this type of thing.
It's very exciting. And Charles, you have in BTCS like a pretty big pile of Ether, and Sid mentioned the digital asset treasuries, which has sort of been a big thing, moving from Bitcoin with MicroStrategy into other digital assets like Ethereum and Solana, and we're seeing other layer ones as well, with Ethereum more so this year. What do you think about the value that these DATs are bringing, and how you guys actually differ from just raising capital to just buy Ether, between actually, what's the importance on participating in the ecosystem, whether it's DeFi or just the blockchain itself?
So I think first, it makes a lot of sense to put a public wrapper around crypto. It gives easy access for someone that's in a 401k or an IRA that may not be able to get on chain, or buy that in a Coinbase account, or a hedge fund that has a mandate that doesn't allow them to interact directly on chain. And then the question is, well, what are these things worth, right? So if you're just a DAT and you're going to go buy Ether or Bitcoin and that's all you're going to do and hold it, like, you're basically an ETF. Why should you trade at a premium? You should trade at NAV. And so for our company, we look at generating alpha through operations, and our operations are node ops. So we actually run validator nodes. We are a block builder, so we account for anywhere between 1% and 3% of all transactions on Ethereum. And we're entering some new business lines around in the DeFi space. And so we have 3 revenue-generating operations that none of the other DATs have in the public markets. And then you couple that with probably one of the lowest cost of capital mechanisms that we use to raise funds. And there's 3 components to that. So 1, we have an ATM, so we can just sell shares into the market when we like the price. 2, we've done some above-market converts, which are about 40% less dilutive than the ATM, assuming conversion. And the third is, and I think we're the only public company doing this at the moment, we use DeFi. So we've borrowed north of $50 million on Aave in USDT, secured by our Ethereum, which is over collateralized, and generating, we generate rewards on the collateral that's posted in ETH, and then we're able to deploy the borrowed money. And that's perpetual debt. We never have to repay. It's on chain. It's easily accessible. And if you just kind of think like what that means, imagine if you fired every banker, closed every brick and mortar shop, and then took the whole process they do, put it in code, put it online, and do it on a global scale. And that's effectively what Aave has done, and we're able to borrow at a very low interest rate, and effectively have a leveraged play without any cost of capital, because we're over collateralized. We actually make more than the borrow cost. And so that's something really unique that I assume, I imagine a lot of other public companies will start realizing that there's a much cheaper cost of capital than what exists in the traditional markets.
Some of these DATs, like, it seems like there's almost like a cult, like, following MicroStrategy, and the people are just investing so much, and they're just finding other ways to raise capital through other vehicles to buy. Do you see risks in these digital asset treasuries too? Like, where, if there's volatility in these digital assets, and if they aren't collateralized well enough, then that maybe they'll go down, and that could actually hurt the digital asset industry?
I don't think so. I mean, when you look at and I know there's been a lot of myths that, like, hey, all these companies, if the price goes down, they're going to be forced to sell, and it's going to create this death spiral that's going to crash the price of ETH or Bitcoin. And I don't think that really exists. Most of the companies, I mean, apart from maybe MicroStrategy, which has sliced and diced its cap table so well with this preferred and that convert, and I mean, I can't even keep track of how sliced it is. But most of the others are not leveraged. I think we're one of the few ones that are using on-chain debt. Our traditional converts are 2 years, but it's a very small slug. And so if you don't have any debt, and you merged into some zombie biotech company and put $500 million in, you're fine, right? It doesn't really matter. Like you can, the NASDAQ company you merged into was a $3 million market cap that was just, surviving. And now you've got $500 million or $250 million in this thing. Like, it's gonna be really hard to go out of business. Like, the token you buy has to basically blow up. I mean, you have to get, it's gotta be like Terra, right? So if you're buying Bitcoin or Ethereum that have longevity, I just don't really see them going away. I can see a lot of them trading below the net asset value because people say, well, you're burning too much money. I'm better off, the expense ratio is better off in an ETF, and you're not doing anything to generate alpha for me as an investor. So I could see them sit at not trade very well, but I don't see them necessarily going out of business or creating broader pressure on the underlying token. Yeah.
No, I agree, and I think that I think the retail traders and individual investors, I think they need to, if they think like these institutional investors, that they're not, I don't think MicroStrategy has any plans to sell in a year or 2 years. The investment horizon of smart investors is like very long term, and like 5 to 10 years, as long as you don't go too crazy like MicroStrategy and do something that's too risky, like the long term play, it seems like it's going to work out for these bigger players. Roshan, we don't have a lot of time left. I know we're at the end of the day here, but maybe you can just talk about 2026 and sort of that long-term investment, the long-term horizon of the institutions. And you guys are just like coming into the US after having all this success internationally, jumping in at a great time. How do you successfully start working with these institutions in getting them locked in? Because I feel like working with a crypto exchange, it's sort of like working with banks. Once you're in, for example, there's a lot of people, Coinbase, they're holding the BTC funds for these companies, and it's like, why should they be incentivized to switch banks or switch asset holders? How does OKX deal with that in whether it's getting people from other exchanges or just finding new institutions as new ones get involved?
No, listen, we're just at the beginning of this whole market, right? Like in the sense that if you look at, you rightly said that if you look at the entire capital market space, you're looking at a quadrillion-dollar industry that is, sprouted and spread its wings over the last 50 odd years, right? And you're talking about various asset classes. You're talking about equities and commodities and FX and fixed income and all of those markets together. Sort of, it's a huge market, right? The world of traditional finance, it's a huge market, and we are at, we are probably a very, very small part of it. Crypto as an industry is probably around $3.5 to $4 trillion right now in market cap. And within that, if you look at DeFi, the entire DeFi market cap is probably a very small part of that, right? I believe that over the next, by 2030, it is, if you look at the growth rate, by 2030, we'll reach around $230 to $250 billion of market cap. So now you see how that sort of stacks down, right? But the power of this technology is that, very soon we'll reach a tipping point where more and more products that currently exist in this quadrillion-dollar marketplace will start to enter public blockchains. And that is the opportunity. And when you look at it from that perspective now, I think the firms that are currently in this space is too few, right? So it's a large market, and even if you capture a little bit of that alpha, that's going to be good enough for the future. So that's my first spiel here. The second is, as you get into this, into 2026 and the future, more and more institutions are looking for very compliant, strong firms who can come in and act as the infrastructure behind these markets on public blockchains. And that's why these years of building in the space is going to sort of really fall into our favor, in my view, right? Where we've taken the pains to build slowly and build the right and the most compliant engineering architecture in the space, and that's what institutions are looking at. looking at all of the governance, the compliance, the risk management that exist when you're actually providing a marketplace that those institutions can come into. And that's what we're building. So yes, there's going to be a whole host of new customers, and there's going to be, multi-trillion-dollar markets that are getting created in this space.
Yeah, it's so small, and we're still at the beginning, and it's so exciting. And I'm so glad that the administration is like green light. I'm sure you guys are all happy, that it's like we're good to go and build this empire and rebuild the stock market, tokenize assets, bring liquidity, make everything faster, cheaper, more decentralized a little bit. And yeah, I'm super excited. I really appreciate all the insights of all the experts on the panel. Thank you to everybody for sticking around. That's all we have, and that's pretty much the end of day one. We're going to be closing it out. Thank you so much, guys.
Absolutely. Thank you once again. Appreciate you all.